Markets start the week subdued. 30 minutes until the start of cash trading. I'm Matt Miller.
I'm Sonali Basak. Katie Greifeld is off today, and Bloomberg Open Interest starts right now.
All right, we are kind of chilled out right now, but there's so much going on this week. Central bank decisions, traders divided on how big a rate cut the Fed will deliver on Wednesday. The S&P 500 has mostly bounced back from its summer sell-off, but the recovery isn't being led by big tech. Instead, it's everyone else's turn. And an apparent assassination attempt on Donald Trump foiled. We've got the latest on another shocking development in the chaotic 2024 race. And let's take a look at where markets are trading right now, because if you just look at the futures, you'll see not a lot of action here. S&P futures pretty much unchanged. NASDAQ futures down, and the 10-year yield holding steady at 364, 365. But we did have the yen with a 130 handle for the first time since 2023. So the dollar weakening against a strengthening yen ahead of the Fed decision to come on Wednesday.
Let's look under the hood here for a few movers, shall we? We can take a look at Apple, down about 2.5% pre-market. A new analyst report notes that based on this first weekend pre-order analysis, demand for the iPhone 16 Pro series is lower than expected. And of course, you have some weakness there in big tech. But Intel on the other side here, up 2.5% pre-market. The chipmaker officially qualified for as much as $3.5 billion in federal grants to make semiconductors for the Pentagon, according to people familiar with the matter. Some good news finally for Intel, Matt.
Yeah, if they don't have any customers, we'll give them customers. It's a big week for central banks as investors prepare for the Fed to cut rates. The BOE and the BOJ also decide on policy. Take a look at this mega wall. We're expecting the Fed to cut either 25 or 50 basis points. Right now, the pricing is the majority of bets from traders are for 50 basis point cut, and Bill Dudley is out with the piece on the Bloomberg terminal this morning arguing for it as well. The BOE and the BOJ on hold, but I think it's more likely we get a 25 basis point cut, considering that of all the major banks on Wall Street that you cover so closely, only one, JP Morgan, is arguing for 50 basis points.
It's fascinating. Bill Dudley, another prominent voice, arguing for that 50 basis point rate cut as well. But what signal would that send to the market? Another thing, we've been watching that carry trade. It would be more stable if the Bank of Japan holds stable and we only get that 25 basis point rate cut. Let's see where the week brings us.
That's a good point. That's something that Dudley didn't mention, because he outlined the cases for both, and he didn't mention the carry trade. I think is really an interesting argument, Sonali. Bloomberg spoke to PIMCO's CEO, Manny Roman, to discuss his thoughts on the upcoming Fed decision.
We're in the camp of 25, but, you know, I always say we have a crystal ball, and at the end of the day, we'll see what the market does. You know, it may very well be that it doesn't make that much of a difference. There will be 3 cuts of 25, and at the end of the day, what matters is where we are at the end of the year. The total sum of the rate cuts may matter more than how they do it.
Joining us now is Amanda Agati, CIO for Asset Management Group, the Asset Management Group at PNC. And Amanda, I mean, what's your take? It's essentially a toss-up right now. Do we get 50 or 25?
Well, it's always nice to be with you. Thanks so much for having me. We're in that 25 basis point camp as well. We really think that going 50 basis points this week sends the wrong signal that perhaps we're too late to this party, or maybe the party's ending too abruptly. And so we think 25 is the right first step. And I think we're mostly in lockstep with the consensus view that the ultimate destination is what matters. It's not one 25 basis point rate cut or another. It's the sum total of what we expect to see well into 2025.
It's interesting that our argument about 50 being too much for the market, really, the tough signal about slowing growth. But it's also hard, Amanda, to think about whether they cut 50 basis points and there's an adverse reaction. We were talking about some of the reasons there might be one, but do you really think that that's how it would play out?
Well, it's sort of interesting to see how futures markets are moving. I always describe the market as sort of a kid in candy store, craving the sugar high for more policy accommodation. So the market wants what the market wants. It doesn't necessarily know what's good for it. And so I do think there'll be a little bit of noise and volatility if we get 25 as the market's really starting to move towards wanting 50. But I think 50 signals that something bigger and more fundamental may be breaking down in the backdrop, and the data just doesn't support that, at least not what we're seeing.
Yeah, I mean, we're already seeing stocks near record highs, Amanda. The economy growing at 2.5%, 3%, unemployment at 4.2%. Does it really look bad? I mean, aren't we on track for a soft landing?
Yeah, it's not too shabby, is it? We're still very much in the soft landing camp as well. I think when you look at the data up until the last few months, it's all effectively come in a bit stronger and surprisingly so than expected. And so that's the good news. We don't see the sky falling. We don't see, standing at the edge of a recessionary cliff here. But there are some cracks that are starting to form, and certainly the labor market is showing a few signs of weakness. So we absolutely think it's right for the Fed to start cutting here and recalibrate, even if for no other reason than where real yields have moved to. There's some recalibration that needs to happen here to reset financial conditions. But we think if they start now and kind of keep chipping away at it, that elusive soft landing may be engineered after all.
I also want to acknowledge the swarm of central bank decisions that we really have this week and recognize that even though that the Fed's decision here is what U.S. investors are watching so very closely, how much volatility could there be around the other rate decisions? If you think about the carry trade and the linkages, for example, there have been between Japan and the United States, do you think that investors should be expecting some strange movements this week?
I think so, absolutely. I've been saying hashtag choppy is the word for the second half here. And based on how things played out at the beginning of August and the carry trade influence there in terms of the market downdraft, investors should be paying close attention to what happens with the BOJ. I think what's also sort of interesting is the central bank moves are a little bit out of whack. That's maybe a technical term for you relative to history. We don't usually see the Fed a little bit behind others in terms of taking the step. They're usually the leader. So it's important for the Fed to take action this week. But I think the BOJ hopefully has learned a little bit of lesson from what happened the last time around. But we'll see. It'll be an interesting meeting to see how they handle things.
So what do you buy after, I mean, assuming we get a cut, Amanda, I imagine the market will be happy about that, or is it buy the rumor, sell the news in the case of a 25 basis point cut?
It feels a little bit like a snoozer. That's my term for it, that the market has already kind of moved to anticipate some of these policy actions. And with valuations sitting at near price to perfection levels and the earnings growth backdrop starting to slow pretty materially, at least just for Q3 expectations, I don't know that there's, a table pounding opportunity at the moment. We're still very focused on diversified exposures across equities in terms of capitalization and style and really leaning into quality. I think it's still the name of the game here, despite what happens this week.
But what about, we have a story on the Bloomberg terminal about a rotation in terms of earnings. The 493 are catching up to the Mag 7, and it looks like that's what the market was doing as well. On the other hand, we're going to talk to Natalia a little bit later, is going to tell us that everyone's buying Mag 7 stocks now. Who benefits the most over the medium term if you get cuts coming from the Fed?
Oh, the bottom 493 for sure. Yeah. But I think this first rate cut doesn't mean all that much for small and mid. And that's been where a ton of pressure actually has been in terms of equity capitalization. And so a few more rate cuts under our belt here, and I think it actually makes a world of difference for small and mid. So I'm interested in quality as it relates to the large cap and the S&P 500 exposure there, but I'm a lot more interested in picking up some opportunities in small and mid. It just feels a little bit early to back up the truck there.
Speaking of backing up the truck, you have BlackRock warning on the bond market, saying that the rate cut bets are overdone. And we have to recognize that there's still so much uncertainty for what may come this week, let alone what may come for the next 6 to 12 months. Amanda, do you have any underlying concerns at this moment about the direction of inflation, particularly heading into and out of the election at this point?
I don't have any particular concerns at the moment. I think in general, it seems like we're starting to get that inflation battle a bit more under control. I don't know that we're particularly out of the woods yet. If you look at the services side of the equation, it's still running pretty hot. But on balance, it feels like we're getting to a more tame place. But that's why I think I'm a little hesitant to say, oh, we should go 50 right out of the gate here this week and another 50 on top of that, which is what the market is thinking. I think going too aggressively right out of the gate may catalyze a little bit of additional inflationary fire that we really don't want at this stage of the cycle.
Amanda, great having you on the program. Thanks very much for joining us. PNC's Amanda Agati talking to us to kick off the week, a week in which we'll get a Fed decision, the first rate cuts that we've had in years. Get a check on futures right now. For that, we get over to, the boards here. S&P futures unchanged, as you saw earlier. NASDAQ futures down 0.5%. And Russell 2000 futures, this rotation looks to be happening at least early on a Monday morning, gaining here. In terms of the stocks moving ahead of the opening bell, the individual names in the pre-market, let's get over to Abigail Doolittle. Abby?
Well, we do have Apple down sharply here, down 2.5% after last week's big rally. That has to do with this cooling of risk sentiment that we're seeing today. In part, we're seeing it also for the shares of NVIDIA after a 16% gain last week. That stock now down in the pre-market as well, back below its 50-day moving average. So folks rethinking the buy the dip of the big tech names. Turning to the shares of Clorox, we are going to see that they are lower. This after a Colgate-Palmolive, after a massive rally over the last year, more than 40% higher, having to do with big growth. Well, Wells Fargo today cutting these shares to underperform from equal weight. That's essentially a sell rating, saying that the epic run, the growth, well, it's priced in. Investors taking that seriously with the stock down 1.5%. And then finally, DJT, Trump Media and Technology up 1.1%. This after a big gain last week after Donald Trump says he will not be selling shares. In addition, we had that apparent assassination attempt over the weekend. The last time that happened in July, the shares rallied in a big way. Today, a modest rally after, again, last week's gain. Sonali.
Abigail, thank you so very much. Now coming up, former President Trump is safe after a second assassination attempt in 2 months. More on that next. This is Bloomberg.
Getting out of high interest to look at what's making headlines around the world. Disney's Shogun claimed the top prize at the Emmys last night. The show picked up the Best Drama Award, the first time Disney won it in 19 years. The adaptation of a 1975 novel is the first series in a language other than English to claim the award. It also shattered the record for most wins by a show in a single year, achieving 18 across the Primetime Emmys and the Creative Arts Awards. Meanwhile, Apollo agreed to a $1 billion pipeline purchase. Let's get back to that story. For a non-controlling stake in a key Caspian region natural gas pipeline. The move will help the energy major relocate some of its resources amid a slump in crude prices, while the upside for Apollo is access to a key gas project. And the race for the White House saw another dramatic development yesterday after members of the Secret Service engaged what law enforcement described as a rifle-wielding potential assassin near former President Donald Trump on Sunday. An eruption of gunfire at the Palm Beach course ensued before a 58-year-old suspect was detained by law enforcement.
And joining us now with more is Jack Fitzpatrick of Bloomberg Government. And let's talk about not only the events of this weekend, but also the response, particularly the congressional response and fallout for how to handle what happened.
Well, there's going to be a significant congressional response. There already was congressional scrutiny of the Secret Service after the failed assassination attempt in July. There's a bipartisan House panel that has been focused on that. The Senate also put off its bill to fund the Secret Service as members looked into if the agency needs more resources. Now, the acting director of the Secret Service told them a couple weeks ago the agency was not lacking in resources. It wasn't a lack of resources that led to that near miss in July, but now there's just heightened scrutiny. About 15 minutes ago, Speaker Johnson tweeted that figuring out how there have been multiple assassination attempts on one candidate is going to be a top priority. And President Biden just told reporters he thinks the Secret Service may need more resources. So it's an agency that has said they should have what they need to do their jobs in the near term, but they may be under some pressure to come up with a better plan to better protect candidates in the near future.
I still see, Jack, I look at WSL election on the Bloomberg terminal at least a few times every day, and I still see, in terms of the betting markets, Kamala Harris 57%, Donald Trump 46%. He didn't get the same boost with this alleged attempted assassination that he did last time when we actually saw bullets flying. Do you expect the campaign to get a bump throughout the week?
It's really hard to say, especially looking back at the July attempted assassination. That was such a major event in American politics. And then, the spotlight was on that for about a week before President Biden announced that he was stepping aside as the Democratic nominee. The main story after that was the momentum that Kamala Harris had quickly gotten going. So this has been such a chaotic presidential election and campaign season that while this is a very major event that's putting a spotlight on Trump, it's very hard to figure out what everybody's going to be talking about a couple weeks from now. So for now, we know it's a close race. All the polling shows it's a close race. Any one major event can make a difference, but it's very hard to predict what the dominant narrative is going to be very far into the future.
You think about Kamala Harris's response here, the vice president's response: violence has no place in America. This is the second assassination attempt in 2 months. And at the end of the day, when you think about how we head toward the election and the unity that both tickets, let's say, had been trying to at least initially run on, do you think that unity lasts until November? What's the risk here that this creates more division in this?
Well, there's been somewhat of an attempt at unity even before this, and it's true, Kamala Harris, President Biden, a bipartisan group of members of Congress have said there's no place for violence. You've heard the kind of statements you would hope to hear from political leaders in the wake of this. You also, incidentally, actually had a handshake between the two candidates at the debate last week and at an event on September 11th after a bit of a lack of handshakes recently among candidates when Trump is involved. So there are some attempts at what you would normally call the normal means of comity in American politics, but it's a bit of an uphill battle given the way the rhetoric has been recently. So it's some moderately good news on the intensity of the rhetoric recently.
For us, Jack, of course, Bloomberg is focused on kind of the intersection between Washington and Wall Street, as are you and I. And Scott Trennert out at Citi has led a group of strategists in trying to figure out what each candidate's economic policies would mean for the stock market. They figure Kamala Harris's policies with her increase in taxes across many categories would hurt the fair value of the stock market by 4 to 6%, whereas Trump's would hurt the fair value of the stock market between 0 and 4%. So it looks like, as usual, stock market commentators are saying that the Democrats would be worse for prices than Republicans.
Yeah, and that's a broad view of it that largely matches what you would at least vaguely understand from their fiscal policies. Harris's proposals on the tax front involves some proposed increase on the top earners, more along the lines of what you've heard from President Biden. There is sort of a countervailing concern, though, about the amount that a Trump administration could add to the federal debt. So one way of looking at it is what that means for the stock market. There are also concerns about the long-term sustainability of these fiscal proposals. Really, there are still some specifics to be hashed out for what both candidates would prioritize on taxes. But we do know that there are tax deadlines coming up, and the next president will have a major focus on tax policy early in their administration.
Jack, great to get some time with you. Thanks so much for joining us. Jack Fitzpatrick there of Bloomberg Government. For the latest developments on the U.S. elections, you can type ELEC GO, E-L-E-C GO, on your Bloomberg terminal. Coming up, Intel could be supplying chips for the U.S. military. So they finally found a really good customer. We'll have details next. In Social Climbers, this is Bloomberg.
And it's time now for Social Climbers, the companies making waves this morning. First up, Disney and DirecTV are calling a truce. The company's announcing that a new deal that will restore ESPN, ABC, FX, and the Disney Channel to DirecTV lineup after a nearly 2-week blackout. The deal was reached just a day ahead of a full day of college football over the weekend and on the eve of the Emmy Awards on Sunday. And next, Intel has officially qualified for as much as $3.5 billion in federal grants to make chips for the Pentagon. Intel has always been the front runner for this award, but there's been pushback from other chip makers as well as concerns in Washington about relying on one firm. The funding could be announced as soon as next week. Finally, Exact Sciences announcing today that a blood-based test that it's developing showed promise in accurately detecting colon cancer. The company said its test detected 88.3% of cancers. And you can follow all the latest company buzz on TREN Go on your Bloomberg terminal, Matt.
All right, let's get a quick check on what's going on in the markets to kick off this trading week. Of course, we do have the Fed decision coming out on Wednesday. We've seen not a lot of movement in terms of S&P futures. Right now you can see that they're down just 0.07%. NASDAQ futures are off 0.5%, and Russell 2000 futures, the small caps, are gaining. It's interesting, though, if you look under the hood, and a lot of individual movers to talk about today, and really questions about where people are buying. Are they buying the Mag 7 stocks or not? Coming up, we're going to speak with Jason Trennert of Strategas on why he thinks inflationary pressures will remain well into the future. That could hold the Fed back. This is Bloomberg. Moments away from the start of trading, this is Bloomberg Open Interest. I'm Matt Miller. We got just 20 seconds until the cash trade, and futures are showing not a lot going on in terms of S&P stocks. NASDAQ futures are down about 0.5%. Looks like we have some gains in small caps. So maybe you do see more of a rotation today. We had a story out on the terminal saying that the S&P 493 have really caught up in terms of posting earnings, while investors have shied away from the Mag 7. On the other hand, we do see a lot of positioning from hedge funds in the Mag 7. We'll talk about that later on in the program. There you hear the bell, K-Force ringing it down the New York Stock Exchange. You see, in terms of the cash trade, it takes a couple seconds for things to really get started, but this is still a futures picture. We are close. We are near as can be to an all-time record, right? 56.67 is the record on the S&P, and we're just less than 40 points away from that on the Friday close. Let's get over to Sonali with some of the first trades. Intel is one of them. Sonali, you want to take that over?
Yeah, sure. Let's take it over. Let's talk about Intel because, of course, we have seen Intel on the rise this morning because the chipmaker has officially qualified for as much as $3.5 billion in federal grants to make semiconductors for the Pentagon. That's according to people familiar with the matter, but you only see Intel up about 0.8%. Really, it was up higher pre-market. We'll keep an eye on that through the trade. Keeping an eye also on Trump Media and Technology. This is the ticker DJT. Donald Trump said that he has absolutely no intention of selling his stake. When a lockup period expires later this week, you are seeing DJT up about 1.5% as the market opens. And Apple, an analyst report notes that based on the first weekend pre-order analysis that was made, demand for the iPhone 16 Pro series is lower than expected. You see Apple shares down at the open almost 3%. Let's take a look with Abigail Doolittle.
Yeah, that's right, Sonali. And on the year, we do have Apple trading higher, up about 12%. It's interesting because it hasn't been a smooth ride. Initially, the stock had been down more than 10%, then up 40%, down about 6% from that high. Overall, there's a bit of a topping area there, a concern given the fact that we do have this analyst over at TF International Securities saying that the iPhone 16 first pre-weekend pre-order sales estimated at about 37 million units, down nearly 13% on a year-over-year basis, that from last year's iPhone 15. So that's not what folks were expecting at all. So there is, of course, that intense competition with Chinese makers. Let's take a look at the importance of the iPhone to Apple, just in case you didn't know, but we can look at it more specifically. I think everybody does associate the iPhone most with Apple, but they, of course, have lots of other businesses going on, services, which they've been trying to build up, about 24% of the pie, and then a myriad of other businesses. But take a look, Matt, there at that iPhone, 52%, and they want that strength. There was a lot of hype going into the release of this phone saying it was going to be the next great thing that everybody was going to buy. Well, apparently the first weekend really not showing that.
But did you buy one, Abigail?
I don't, because right now I have an iPhone 14 Pro and an iPhone 15, so I'm set right now.
A couple. All right. Well, yeah, I guess that's good enough. Abigail Doolittle, thanks very much for that. Let's talk about what's going on in this market, in this economy, ahead of, obviously, the big Fed meeting on Wednesday. The debate right now, is it 50 or is it 25? But there are real issues, obviously, underlining that decision. Joining us is Jason Trennert, chairman at Strategas Research Partners. Jason, great to have you on the program. Thanks so much for joining us.
Thanks for having me. I appreciate it.
What do you think about, it seems like this Fed typically likes to telegraph things before they unleash them on the market. So even if there are arguments for 50 basis points, and Bill Dudley is out this morning saying that, the labor market is the biggest argument for that. What is your expectation for the actual cut?
My best guess is that it's going to be 50. I don't necessarily believe that's the right move, but I do think it's likely to be 50. And that's because I'm getting the inclination that Chairman Powell wants 50.
They're telegraphing it to you.
Well, not necessarily, but I think, there could be a difference between the committee and the chairman, but I've been told from people that are very familiar with this and have been on the Fed that it's not a democracy. There could be dissents, there could be other things, but largely it's the chairman's decision.
Why 50? What is the case for 50?
The strongest case for 50 is that you are at your maximum difference between the Fed funds rate and the inflation rate. Right, so this is your least chance of making a mistake if you go big, because you're at the very beginning of the easing cycle, right? So the real Fed funds rate is as high, hopefully, as it's going to be. So that's the strongest argument, I would say. I have concerns about another wave of inflation. I think there are structural reasons why another wave of inflation is possible, if not likely, in the future. So I would kind of argue for going more slowly, but my opinion doesn't make any difference. I do think the stock market will be disappointed if it doesn't get 50. I think it will be elated if it does get 50. And so we'll see. And then the statement will also have a big impact, right? The forward guidance that you get from the statement will also be important.
The other question I have that is probably lesser looked at this week because of the Fed press conference coming up is the fact that the House Republicans are searching for a plan to avert a government shutdown in 15 days. Sorry. Do you think that the fiscal issues that this country is facing is baked into a risk premium here in the bond market? Is some of this not about the economy itself and about kind of the state of our country?
Sonali, it's a great question. My own opinion, and this is just from dealing with institutional investors all day long, every day, is that very few people are talking about the government shutdown, and I don't think the fiscal issues are clearly that big an issue because we have $35 trillion in debt total. So people are just kind of made their peace with it, that we have the reserve currency and therefore we can get away with murder financially, right? So At a certain point, though, I do think the bill will come due. There is a limit to what you can do, and that will largely be, in my opinion, exhibited in the bond market at some point. But right now, I don't think it's in there.
Is there any? You mentioned your concern about inflation. I think it's very interesting. Mark Zandi at Moody's said that the rate cut would go a long way to take the Fed's boot off the neck of the economy. I thought it was a great way to put it. But don't you want to keep it there if you're worried about inflation?
Yeah, I mean, listen, I think I would with Mark, and I don't know him personally, but I would just say, listen, if you look at financial conditions are pretty easy, right? Corporate credit spreads are tight. We're within less than 1% from the highs in the S&P 500. The unemployment rate's 4.2%, which Stanley is probably too young, but I mean, when I was coming out of college, that was considered like more than full employment. So I'm not so sure what the rush.
I mean, they want sustainable maximum employment, right? So
right.
3.4 is not sustainable, right?
Right, precisely. So I think, in my opinion, I would kind of go more slowly. And the structural issues I'm talking about are an end to globalization. I think that's a biggie. I do think that the deficits that we have right now, which are about 7% of GDP, not sustainable. There's no coordination between fiscal and monetary policy. And so these
the
are
IRA,
things,
the CHIPS Act.
Right, you have all of these things. It's very, very difficult to get control of inflation over the longer term if there's no coordination.
Bigger problem that I see actually is what you call the common man CPI.
Right.
You have written to us that what you track, and this is the things that you would buy as any American: food, shelter, energy, children's clothing, that has been outpacing the headline number.
Right.
Daycare, dog care for that matter, right?
Dog care, right.
So if that is the case, then how could it also be the case that we're okay with the state of inflation today, that we're ready to cut 50 basis points?
Listen, I think, again, there's two, obviously the Fed has two mandates, right, which is full employment and inflation. If you're looking at from the employment picture, you're up from 3.4 to 4.2%. If you use the SOM rule, you'd say, a recession is imminent.
Many economists think barreling towards 5%.
Right, so so that could be a rationale. But I do think, my own opinion, talking about the common man CPI, we just use the things in the CPI that people have to buy every day. So it's food, energy, shelter, children's clothing, insurance, and utilities. And so what you've noticed there, when we look at that, that's outpaced the headline inflation number in 38 of the last 43 months. And it's growing faster than wages. So that's part of the reason why I think people are so grumpy. And I can understand the Biden administration's, several months ago, they were saying, like, why aren't we getting more credit on the economy? Because the stock market's high and the unemployment rate's relatively low. The reason why they're not getting more credit is that for the average person, their standard of living has deteriorated over the past 3.5 years. Their purchasing power has weakened. And so that's why people are grumpy, despite the fact that it might look good on the outside. And that's why I think inflation will remain. I think it will be one of the, if not the biggest issue in the election in 7 weeks, among the top two issues in the election.
Perhaps one of the biggest issues coming out. Jason, we thank you so much for joining us today.
Thank you.
Is Jason.
We're gonna stick with him. So we're gonna keep talking to him after this break.
No, we actually have a new guest coming up.
Oh,
a surprise for you, Matthew.
I see.
But hang tight. We will have Jason back on this program soon. That is for sure. That is Jason Trennert of Strategas Research Partners. Thank you. Now, coming up, former New York Fed President Bill Dudley, the man who's been calling for 50, says the Fed should go big now, and he thinks that it will. We're going to talk to him next on why. This is Bloomberg.
I see.
Former New York Fed President Bill Dudley says the case for an aggressive cut when the Fed meets this week makes sense. In a Bloomberg opinion column out today, he writes that the logic supporting a 50 basis point cut is compelling, and that the downside risks to employment outweigh upside risks to inflation. And we are now joined by Bill Dudley. And if you think about the days ahead, if you think about that case for 50 and why we're still standing here days before on a razor's edge, why is it that the expectations seem to be changing so quickly, not only for the market, but even inside the Fed?
I think what happened was last week we got two articles, one in the Wall Street Journal, the other in the Financial Times, that basically said the issue of 25 versus 50 basis points is open. And basically the people in those articles, including myself and one of them, basically made the case that the logic for 50 basis points was pretty compelling. And I think as people have reflected on that, and the Fed hasn't pushed back against the change in expectations, the market has come to the view that 50 basis points at this meeting is in fact appropriate. I think what happened was that Powell, I think, thought about it a little bit more and decided that the deterioration that we've seen in the labor market over the last few months means that the downside risks of the labor market probably outweigh the upside risks to inflation at a time that monetary policy is tight. So it's pretty important that the Fed head back to neutral expeditiously, and that 25 basis points wasn't fast enough.
I was fascinated by your column and the point you make about maximum sustainable unemployment. I always hear maximum employment, and it's great to see the sustainable in there, because it seems to me 4.2% is a lot more sustainable than 3.4%. Do you really want to push back towards those incredible lows?
No, I don't think so. I mean, I think the Fed in their summary of economic projections we're going to set this week basically thinks that full employment is around 4%. By that, I mean, at 4% unemployment, you're not going to get upward pressure on inflation or downward pressure on inflation. You could just sit there. So right now we're running at an unemployment rate a little bit above that, which just reinforces the Fed's view that the downward pressure on inflation is going to persist.
Why, Bill, are you not more concerned about inflation itself? With the November election just around the corner as well, and two presidents that may introduce policies that could be inflationary, why would 50 be the right thing to do now with the labor market in sight and lesser worries here about the reacceleration or at least sticky inflation?
I think it's because the Fed takes the world as it is and doesn't speculate about what's going to happen in the future, or who's going to win the election, what policies set they're actually going to get. That's going to take, quite a few months to play out. I mean, the new president won't be coming in until late January. So I think the Fed's view is we got to set policy based on what we see today, what we see on the risks of inflation versus the labor market. And, if the policies that are pursued by the next president turn out to be inflationary, then the Fed will adjust policy appropriately at that time.
In terms of the terminal rate, and you mentioned in your column that it's far more important than how we get there. What do you see? Because neutral is what, 3%? Is it 2.5 or 3.5?
There's a lot of arguments about where neutral is. I think all we can say is it's well below where we are today. The Federal Reserve's central tendency for neutral is 2.8% federal funds rate at 2% inflation. I would probably have a little bit higher rate than that, more like 3.5%. But 3.5% federal funds rate is still far below where we are today, nearly 200 basis points below where we are today. So the point is there's a long way to go, even if you don't know precisely where neutral is. And so it makes sense to start heading in that direction.
Bill, given the concerns about the labor market, perhaps you can draw out what the world looks like, what the United States looks like if we only go 25, if they take a more conservative stance in cutting here. What does the labor market look like?
Well, it's probably not a disaster, right? Because the market's anticipating, a lot of rate cuts over the months and years ahead. So the fact that they get there a little bit more slowly is not a disaster. But why would you want to take more risk on the labor market at a time that the labor market's already shown some deterioration? The Sovereign rule basically tells you that when the labor market deteriorates beyond a certain point, the risk is that it becomes self-reinforcing, and then you have a full-blown recession. So waiting increases that risk, not dramatically, but a little bit. And the question at this point is why would you want to take that risk?
It does seem like you're kind of dovetailing Claudia Sahm and Malcolm Gladwell in your column today on the Terminal. You talk about the tipping point when unemployment, I should say, starts to accelerate, then it really turns down. Is it possible to turn that kind of thing around with rate cuts once it's already started? Is it too late?
Well, that's the whole problem, is that when people hear about the labor market deteriorating, then they start to pull back on their spending. When they pull back on their spending, that means that at least some more layoffs and the whole process becomes self-reinforcing. The good news, though, is that monetary policy, I think, still has long and variable lags, but they're not as long and variable as they used to be because the market anticipates what the Fed's going to do before the Federal Reserve actually does it. So, for example, look at two-year Treasury yields today, way lower than the federal funds rate. So the market's already putting in place easier financial conditions, and that will help support the economy and reduce that risk of recession.
Just incredible. There was almost a 50 basis point move over the past month in the 2-year alone. But you look at the market, and to the point that you've been making about that series of cuts expected over the next year, and the market is still right now anticipating 120 basis points nearly worth of rate cuts this year. Do you think that there's some reason behind that makes sense to you? And what do you think that the Federal Reserve needs to communicate Wednesday about the path forward?
Well, I think what Powell's going to do in the press conference is going to try to calm everyone down, that the 50 basis point rate cut is not because of tremendous alarm about the economy. It's just that we've accomplished our mission of becoming highly confident we're going to get inflation down to 2%. And so the dual mandate objectives are now balanced. And so it's time to head back to neutral. So I think he's going to try to do it in a very low key, non-alarming way. And I think he can make that case pretty well.
But 50 basis points in itself is kind of alarming, considering this is a Fed that's so conservative. They always seem to telegraph every move they make. The market knows about it weeks, if not months before, unless they leak to the Wall Street Journal. Isn't that going to be a problematic sign?
Well, I don't think they communicated this as well as we would like. I mean, people shouldn't be trying to get their information by reading the tea leaves in the Wall Street Journal or the Financial Times. But I think it's partly because the situation changed. The last employment report was not weak for the current month, but there were significant downward revisions to payroll employment for the prior 2 months, so that the 3-month change in payroll employment now is the weakest it's been since 2020. And I think that got the Fed's attention. And I think more and more people sort of made the case that I made. If you really believe that dual mandate objectives are balanced, then policy should be at neutral. So let's get going. Remember, the Fed was really late on the way up. And I think they remember that. And now they don't want to be real late on the way down.
Bill, great to have you on the program. Thanks so much for joining us. Bill Dudley there, former New York Fed president. He is also a Bloomberg opinion columnist, and you can check out his story on the terminal today. Coming up, hedge fund Eisler Capital seeing a fresh round of departures. Wall Street Beat coming up next. We'll tell you who's leaving and who's left. This is Bloomberg. This is Bloomberg Open Interest. Get a quick check on stocks 23 minutes into the session, and we're still seeing a whole lot of nothing on the S&P 500. That may be because investors are selling the Mag 7 and buying the 493. At least it's one columnist on the Bloomberg Terminal argued. The NASDAQ 100 as evidence for that, down 0.6%. The Russell 2000 moving up about 0.2%.
Fascinating, though. This is after a 5-day rally in those Mag 7 stocks. So maybe some cooling, right? Anyway, it's time now for the Wall Street Beat. 10 money managers have left Eisler Capital in recent days. The $4 billion hedge fund is facing a period of poor returns and an intense talent war while it tries to transform into a multi-strategy hedge fund. And for more, we're joined by Bloomberg senior hedge fund reporter Nishant Kumar. And you think about what Eisler has been trying to do. Is there a cautionary tale here? Multi-strats have really been, let's say, the only game in town more recently in hedge funds. But if you try to change too fast and not stick to your knittings, Eisler was a very prominent macro fund, for example. Are there going to be issues in that transferal?
Definitely. It's incredibly hard to become a multi-strat. You just can't compete with the top tier people who are getting the best talent. They have the deepest pocket. They have more experienced people who manage those businesses. And they are a brand that people associate with. So any new entrant is bound to face this kind of a problem. People leaving, yes, it looks really big news and odd, but this is the business model. High turnover is the business model of multi-strat funds. No one is immune to that.
So, put it in perspective for us, Nishant, because to me, at first glance, as someone who isn't as familiar with the industry as you and Sonali, when 10 money managers leave or are dismissed from a hedge fund, it would be a really bad sign. Like if I had my money there, I'd be trying to get it out. Is it normal?
This is very normal, oddly, in the multi-strat world. So all these multi-strats have dozens and dozens and dozens of people. We are talking about more than 100 people, 100 traders here. And we have to think about how they are structured. So you have few individuals who run most of the risk. And then you have a long tail of people who run smaller risk. And that's why those people sometimes get
we got to leave it there, but don't miss Nishant's report on the Bloomberg Terminal, a most read story. Stick with us for the next hour of Open Interest. This is Bloomberg.
We are 30 minutes into the trading day. Bloomberg Open Interest is the name of the show. I'm Matt Miller.
I'm Sonali Basak, and Katie Greifeld is off today. She'll be back next week after the big weeks because it's markets preparing for big central bank decisions this week. Traders are divided on how big a cut the Fed will deliver on Wednesday. And of course, more central banks around the world as well. Also, a crucial week for Boeing. We've got the latest as the Machinists Union and the federal mediators gear up for talks. Plus, it took BMW more than 2 years to discover the extent of a braking system fault that may cost it nearly €1 billion to fix, Matt.
All right, let's get a check on the markets right now. In terms of futures, we're half hour in. In terms of the cash trade, we're up 0.1% on the S&P 500. Not a lot of movement there, but you notice the NASDAQ is down 0.4%, and that suggests a little bit of repositioning. And on that note, hedge funds are back, apparently, to buying big tech stocks. This, according to Morgan Stanley's prime brokerage. Bloomberg's Natalia Knichevich is here to talk about positioning with us, and she knows the inside scoop. Natalia?
Hi, Matt. So yes, hedge funds bought about 2.5 times more long positions than they added on the short side. And then when it comes to single names and specific sectors, much of that buying activity was across TMT stocks. More specifically, Morgan Stanley is saying that hedge funds have been buying the Magnificent Seven names. So Infotech is the leader. Then hedge funds also bought communication services, energy, and both consumer discretionary and consumer staples. On the flip side, we see that hedge funds are selling defensive names, stocks from healthcare and real estate, as well as utilities were among the most net sold sectors. Now let's talk about systematic funds, basically robots. They don't care about fundamentals. They just typically follow the market direction. And this chart shows vol control funds. Typically, when volatility is moving down, they buy stocks. And this is what happened last week. But the reason why I wanted to show this chart is that when we compare this most recent buying activity, it's still way below historic highs. So there is still more room to buy stocks across vol control funds. And finally, let's take a look at the options activity. The next chart basically shows the cost of hedging, or how concerned the options market is about a potential 10% decline in the S&P 500. This chart, if you want to get it, you go to Bloomberg Terminal, you type SPY US equity. This is the largest ETF that tracks the S&P 500 sector and S&P 500, and then you go and type. Basically, you do a ratio of volatility between options 10% below and 10% above the market. So we did see this huge spike somewhere in July, and then the latest one came starting from mid-August till early September, and now it's moving down pretty sharply. And Sonali, to me, this is a really clear signal that, at least for now, anxiety is gone.
But perhaps best to buy protection when it's cheap. Bloomberg's Natalia Nidzevich, thank you so much for all of that analysis. We're going to dive deeper into markets, joined now by Katerina Simonetti. She's Morgan Stanley Private Wealth Advisor and Senior Portfolio Manager. And you did see that rotation into last week. You saw that risk appetite come back. You see a lot of traders on hold, very naturally so, before that big Fed rate decision, really a historic one this week. How does this week change the game? Whether the Fed goes 25 or 50, will that make a big difference to risk appetite?
Well, Sonali and Matt, thank you for having me on the show. You know, we certainly have all of the components of the volatile market here. When we look at the historic nature of leading into the presidential election, coupled by the change in the Fed strategy and the upcoming earnings, you know, there's a lot of volatility that we have seen in the past weeks, and it's going to continue. And the question here is, do we have realistic expectations to what the Fed is going to do? In our view, looking at the weaker than expected CPI numbers last week, we are actually sticking with our guns and saying that, you know, it's going to be probably 25 basis points cut, but the expectations for the Fed is to be pretty aggressive here as we look at the rate cuts that are priced in throughout the end of the year and also for 25.
So what do you think the terminal rate's going to be, Katerina, and what do you want to own in this kind of Fed cutting cycle?
Well, Matt, we are deviating from the cyclicals right now. We're underweight in those, and in our view, the name of the game is quality. What we tell investors to do right now is to focus on the names in energy, in financials, in healthcare, dividend-paying stocks. And if you actually look at the performance of the recent few months of this year, we see this change in leadership from the Magnificent Seven into some of these defensive names. Now, of course, they recently, you know, had a bit of a comeback. So that just comes with the volatility. But over the long run, we are positioning portfolios for owning the names with strong balance sheets, or owning the companies that have strong competitive positioning and pricing power, because that's going to be, going forward, more important than ever. And also, you know, as we go into the earnings season and the election, this is where diversification by asset class and by the sector and also geography matters more than ever.
You know, you think about, for example, some of the conflicting trades you're seeing in the market. Yes, we just got off of a little bit of a rally here for the Magnificent Seven last week, but then also you head into this week and you see gold touching new records. How much of a safety trade do you still need to put on in this market, Katerina? Is it in the form of gold or cash, and by how much?
Sonali, that is probably the biggest questions that investors have right now, because over the last year, we had the benefit of higher rates and we have the benefit of higher yields in cash. So cash was that really nice, safe trade. But going forward, it's not going to be, because once rates are going to start getting cut, we're not going to have that luxury anymore. So going into high quality fixed income, going into the dividend paying stocks, focusing on the income side of the portfolio is going to make a difference, because the cash is no longer going to be that safe haven. And gold is a great defensive asset class, but it also is a non-yielding asset class. So investors that are looking for income generally would stay away from it. But as a hedge, it certainly historically has worked very well.
Katerina, any concern about increased volatility going into the election? And, you know, would you be concerned, Sonali made this point earlier, about inflation re-accelerating once we get a new president in the White House?
Matt, generally, Fed has been very aggressive, you know, when it comes to inflation, and they've got inflation under control, you know, as much as they could, you know. But going forward, I mean, this is a data-driven Fed. So depending on who is going to be our next president and what their policies are going to be, of course, it is a concern. We're looking at the potentially higher spending, but Fed is looking at inflation as one of their core objectives, is to keep the inflation down. So we think that, you know, that is going to very much drive the Fed action.
So at the end of the day, when you think about that path forward with the rate cutting cycle, right now the velocity is pretty intense as far as what the market is expecting. If that doesn't materialize, Katerina, what is the spillover effect into the equity markets, given that the market is currently pricing in nearly 120 basis points worth of rate cuts this year alone?
Absolutely. And Sonali, market is not only pricing in aggressive rate cuts, but it also is pricing in the earnings in the equity sector that is quite aggressively. So while the soft landing is still our core base scenario at this point, the concern here is that if we see the course of action that is disappointing to the market, what this could result in terms of the economic outcome. And that's where, the question here is, do we have unrealistic expectations both towards the rate cuts that are coming and the volume and the speed with which Fed action is going to happen, but at the same time, the earnings, are our company is going to be able to maintain the same level of earnings in the environment where the profits are squeezed? Inflation is, of course, the problem is a major problem for consumers, but for corporations, this is where they're able to price more aggressively. That's no longer is going to be on the table.
Yeah, absolutely. So they won't have that pricing power, maybe won't be able to meet earnings expectations. Are we too high then at S&P 5630? I mean, some targets into year end at 6,000. Are those too aggressive?
Well, Matt, our expectations for the market performance throughout the year end are actually very reserved. We don't think that there is going to be a lot of growth going forward, at least throughout the year end for the remainder of the year. But in our view, that's why we are focusing on quality. That's why we're positioning ourselves in the names that are that have not performed well in the past, while Magnificent Seven was driving the market, but are coming back. And we are gearing portfolios towards dividends, towards quality, and towards this protective defensive positioning as we're going through this volatility. And while market is going to figure out, especially through this earnings season, what we have to look forward to throughout the year end.
Katerina, we only have about a minute left here, but you mentioned energy being one of the sectors that you believe would be a significant place to be looking at right now. But how volatile do you expect this sector to be? Yes, it has had a more recent rally. It is still lagging really every other sector this year in the S&P 500, and energy prices have been extraordinarily volatile. How much is the macro going to really guide the trajectory of a lot of the bright spots that many people are looking to in the markets right now?
Sonali, oil prices are down, and China is a concern. But with that, if we take a look at the broader view at the energy sectors, energy companies, energy producers have been the core components of almost any investment portfolio, specifically because of the dividend aspect and the higher dividend payers, that we see in that sector. So we are actually looking forward, are seeing some buying opportunities, and this is where dollar cost averaging and gradual investment in the sectors for any of the investors who don't have a strong positioning there, makes a lot of sense. But we think going forward, in the broader sense, over the longer time horizon, energy plays a huge role in any diversified portfolio.
Katerina, we thank you so much for your time this Monday. That is Katerina Simonetti, Morgan Stanley Private Wealth Advisor and Senior Portfolio Manager. Let's now get a look at stocks moving under the surface this hour. Here's Abigail Doolittle.
Well, we are certainly looking at a bit of a volatile session, especially for that NASDAQ 100 and the NASDAQ composite for that matter, having to do with big tech. We're seeing a bit of a sell-off for some of the bigger names weighting in those indexes, including Apple, not so long ago down more than 3%. This, of course, after an analyst over at TF International Securities was talking about the idea that the iPhone 16 Pro, well, it's not quite as strong as folks maybe had expected in its first weekend. In fact, down 13% year over year. This seems to be sending these shares lower. As for NVIDIA, after a greater than 15% rally last week, a bit of a snapback in all of its volatility this year, we now have the stock down 1%. So some of those buy the dippers getting out of the way. And I would also note that there's a big range there. It's not clear whether or not this is a clear move move back down into the range, but the stock close, hovering right around that 50-day moving average, telling you the uncertainty that near-term buyers really experiencing. They don't know whether they should keep going in on the AI craze or if it's time to pull back. And then there are some bright spots in technology, including the shares of Intel up about 4%. They've been cleared for $3.5 billion, or the ability to produce $3.5 billion, up to $3.5 billion worth of chips for the Pentagon. And then Oracle receiving an upgrade, up 4% nearly, from Melius to buy from hold. The analyst there, Matt, really liking Oracle's growth.
All right, Abby, thanks very much for that. Abigail Doolittle, look at some of the stocks that are moving. Coming up, Boeing and union workers on strike gear up to begin discussions later this week. We're going to bring you more on that troubled American icon next. This is Bloomberg. Let's get now to high interest. Look at what's making headlines around the world. 3 Democratic senators are urging Fed Chair Jerome Powell and fellow policymakers to aggressively cut the benchmark rate, including by 75 basis points this week. In a letter, Senators Elizabeth Warren, Sheldon Whitehouse, and John Hickenlooper write, quote, "If the Fed is too cautious in cutting rates, it would needlessly risk our economy heading towards a recession." German billionaire Matthias Döpfner and KKR are nearing a deal to break up media giant Axel Springer. The move will split the classifieds unit from its news business. This, according to people with knowledge of the matter. Axel Springer owns Politico and Business Insider, among other publications. A BNP Paribas manager is facing allegations that he ordered staff to cut 60% off of bonuses for female employees in his group to boost pay for male colleagues in London. The claims come from a broker who had previously won a landmark case against the French bank. BNP said it fully investigated the allegations when they were first raised and found no wrongdoing. Sonali?
And Matt, it's a crucial week for Boeing. After hundreds of workers across the West Coast went on strike last week, the firm is set to begin talks with the Machinist Union and federal mediators on Tuesday. For more, let's bring in Bloomberg's deputy editor for global aviation, Sid Phillip. You take a step back. You look at last week. It looked like it was going to be a promising set of conversations between the unions and with Boeing. You fast forward a number of days, things started to fall apart. Where are we now?
So we're currently in day 4 of the strike, and we're waiting for federal negotiators along with Boeing and the union to sit down starting tomorrow, according to the union. And essentially that will determine how long this will go on for and what they can actually achieve from it. So the union's asking for a higher wage offer than the 25% over 4 years that was offered as part of the deal. They're also asking for a reinstatement of the pension for Boeing, and that's really crucial for the negotiations because the workers do have a lot of leverage at the moment.
Pension? That sounds luxurious, as in gets paid for the rest of their lives?
They've asked for a defined benefit pension, which was the case until about 10 years ago when Boeing scrapped that. And so they've asked for a reinstatement of that. And also they're looking at how they can sort of maximize their offer. Because at the moment, Boeing is in a hard place, and the union knows that, and the workers know that, and they haven't had a deal for a while.
That's an important point. Boeing is in a difficult place. Like, if I asked you to list the top 5 problems at Boeing, they would all be giant. Is this really a time for workers to be asking for a pay increase and a defined benefit pension plan?
You could argue it's the best time
for it, right?
But wouldn't they then drive themselves out of a job? I mean, as the company is doing its worst, you want to take more money?
At the same time, I mean, for Boeing, I mean, they have a giant backlog of aircraft. They've got orders for their planes, and they're looking to sort of scale up production. And so as the regulators sort of lift the cap on 38 a month on the 737 MAX, as they can sort of, they're more confident about Boeing's manufacturing quality processes. And as they sort of work towards ramping up production across the other model lines, it is a sort of case that Boeing has a lot of demand for their planes. I mean, it is a duopoly at the moment, and there is only sort of two makers.
Could argue it's too big to fail. And the other
Definitely
end
could argue that.
that makes the point that both of us are making here, perhaps, is what the financial cost could be to Boeing if the strike continues for an elongated period of time.
Absolutely. I mean, some analysts have said that the strike could cost them between $3 and $3.5 billion if it's longer than 50 days, as was previously in 2008.
Could it get that long?
I think Boeing and the union want a quick deal, so I don't know if it'll actually get that long, but we'll have to wait and see.
All right, Sid, thanks so much for joining us. Great having you on. We could talk about Boeing for
all
an
day,
hour.
yeah.
And sometimes we do. Back at our desk, sometimes that's all Sonali and I are talking about is like Taylor Swift and Boeing.
You were talking about Taylor Swift. I'm talking about Boeing.
Still ahead, guacamole-making robots. Maybe making an appearance at a Chipotle near you. We're going to give you more details on this story. I think we've already been talking about this for like a week now. In Social Climbers next, this is Bloomberg.
And it's time now for Social Climbers, the companies making waves this morning. First up, Disney and DirecTV calling a truce. The companies announcing an agreement on a new deal that will restore ESPN, ABC, FX, and the Disney Channel to the DirecTV lineup after a nearly 2-week blackout. The deal was reached just ahead of a full day of college football over the weekend. Next, Trump media is making the rounds after Donald Trump said that he had no intention of selling his stake in the social media platform when a lockup period expires later this week. There are a lot of eyes on that one. Finally, Chipotle robots are ready to serve you. The fast food giant is piloting robots in 2 of its California restaurants. The new bots, called Automakers, can cut, core, and peel avocados in under 30 seconds. Meanwhile, the company has said it will not deploy a robotic tortilla maker called Chippy because it was too hard to clean. I would love all of this for my own kitchen, to be honest with you, Matt. You could be following all the latest company buzz on TREN Go on your Bloomberg terminal.
All right, let's get a quick check on what's going on in the markets away from avocados and looking at the Russell 2000. It's a gainer right now, although we see some of the other indexes falling, the bigger ones, obviously. The S&P 500, the broader benchmark index that we follow, unchanged right now. But the NASDAQ is down, which leads you to ask the question, is it the big tech stocks that are helping to fuel the losses there? Apple, if you look at the S&P, Apple, Nvidia, Broadcom, Amazon, Tesla, Meta, Micron, they're all down. So really among the top losers, Sonali, are these big tech stocks. The gainers are the companies that you follow, right? JP Morgan is up, Berkshire is up. So you see more of these finance companies as well as a couple of the big Microsoft and Oracle.
Totally related to the bond market, isn't it? You had that curve steepener. We love to talk about it. We saw that disinversion. It's supposed to get you to a place where you're worried about a recession. People are shaking that off. However, I'm fascinated. We've been talking about it in every commercial break. This idea that there is so much pressure for the Fed to cut deeper than 25 into Wednesday. Is it warranted? You have Elizabeth Warren and Democrats saying they should cut 75. Is the economy that bad?
Yeah, I think, really interesting. Bill Dudley brought up in his column that one of the arguments against a 50 basis point cut is that it could be seen as political, right? The Trump camp will then argue it's not fair. You're cutting 50 basis points to help the Biden economy into the election. Maybe Elizabeth Warren and these left-wing Democratic senators have run cover for the Fed by asking for an even bigger rate cut.
Right. If they don't cut 75, then did they really meet the needs of the left? I guess not.
I think it's a pretty interesting conspiracy theory and probably not more than that. Still more ahead. This is Bloomberg. BMW took over 2 years to discover the extent of a braking system fault, which is expected to cost the car maker over $1 billion in recalls. A profit warning last week wiped 5 billion euros off of BMW's market cap. Someone who knows well the importance of suppliers, and obviously braking systems are key to that, is Holger Klein, the CEO of ZF Group. He joins us now out of the IAA in Hanover. And Holger, I just thought this story really highlights how key the supplier is to the car makers that we all know and love. what are the warnings that you would take from this Continental BMW problem for ZF Group and maybe fix things in the future? I don't hear sound. Do you?
While we wait to get his sound back, perhaps you could tell me, Matt, about the importance, because I know you and I both love a good Beamer.
Yes.
But not when it's not breaking.
Yes. No. These companies don't make everything in-house. Obviously, BMW, known as the ultimate driving machine, wants to have fantastic brakes in its cars. It gets those brakes supplied by, well, different companies, but Continental in this case. And it took them years to figure out what the problem was. Very expensive to fix it. That's why communication and a relationship with your suppliers is so important. And that's why I wanted to ask Holger what he takes as a lesson from this issue. Could have happened to anyone, I guess, Holger, but what lessons do you take from the problems at Continental and BMW?
Hey, Matt, I think we all understand that the supply base and the OEMs are totally interlinked. And today you reach me here, not on the pass car fair, but on the commercial vehicle fair. Same here. We at ZF, we are one of the largest global suppliers in the world in automotive for pass car and commercial vehicles. And if you would be here, you would hear a lot about innovation. And one key task is, of course, industrializing this innovation. And that is a challenge for all of us in great partnerships. Yeah.
So how, when I think of ZF, I think of the PDK transmissions that you make for Porsches, obviously, and a lot of that exciting stuff that you make for the consumer end. On the commercial side, what are the biggest and most important products that you're pioneering?
So if I could carry you around, I would show you now this truck behind me. And we do basically everything you will need for your trailer, for the engine, the transmissions, braking, autonomous driving, high-tech supercomputers. So ZF is a full liner if you want. And here in Hanover, we speak a lot about the Vision Zero. We talk about zero emissions and zero accidents. And what does that mean? On the one hand side, of course, electric drivetrain is the name of the game. It's coming to the commercial vehicles as well. And it's about zero accidents, so every kind of lane keep, assist, and so on, emergency braking, like you know it from your pass car, but just with 44 tons or so.
Matt knows I am a new car owner. I am quickly falling in love with the industry myself. You had mentioned, it's interesting. A lot of these themes that you've been bringing up, of course, are very sexy in terms of the future of the auto industry. But you yourself point out that the technology change has complications to it. What are some of the biggest challenges you're facing?
Yeah, first of all, you need to convince your customer to buy the product. Yeah, that's why I'm here. Yeah, and the IAA commercial vehicle is very special because we are signing contracts here. Yeah, and if you stay tuned with us, you will hear that we add further volume to our order books for e-vehicles, e-axles. It's 5 billion we already have, and we are very confident that we will continue as ZF to sign contracts here. If you look at the challenges, you need to be always up to date with your technology. And us at ZF, we roll across, so to say, technologies from the pass car to the commercial vehicle. Remember, pass car, high volume, commercial vehicle, lower volume. And that's where we find the synergy on chassis, on electronics, on e-mobility.
It is a very exciting business that you're in, Holger. I worry, though, about Germany and the industry in Europe's biggest economy when I read stories about Volkswagen and BMW, when I see the rising labor costs, the high materials costs, and really the competition that you have out of cheaper labor markets like China. How do you combat that in your economy?
So first of all, Matt, of course, we are present everywhere. Yeah, so we are competing in China ourselves, and I would hope that my dear friends in China would say, hey, that have really tough competition in our local market. Yeah, but you're pointing to another point in Europe. Of course, there are some structural topics we need to address, but I think most of the companies you mentioned, and us at ZF as well, we set up our performance programs to manage those challenges and defend our competitiveness. And high-tech and innovation is part of it. ZF really is leading in technology, broadest technology portfolio in the commercial vehicle sector. So I'm pretty confident.
going back to China here for a moment, because I think it's pretty fair to say that you have the whole world pretty concerned about any potential acceleration of economic slowdown. When you think about the Chinese market, particularly with some of the largest auto companies in the world, you think about the success of BYD, for example. How do you think about this concern?
So a little bit like I just said, in China, you need to play local for local. We are doing it. In our portfolio, we have more than 50% of the revenues coming from Chinese OEMs, and we're growing with them. And this is challenging because you need to adapt China's speed, like with everybody who is participating in the market in China. And for us, it's as well learning than for the other markets. So I wouldn't be all negative about it. And of course, you see a little bit of a slowdown at the moment, but it's a huge market. If you remember, in commercial vehicle, 50% of the global volume is happening in China, in Pescar, perhaps roughly 1/3. So interesting market, technology lovers, innovation driven, and it's great to be there as a global player.
Great conversation on the global industry and especially on the technology that you're producing for the commercial fleet, which is, I'm sure, from a business perspective, very exciting. For me, though, it's all about the transmissions that you make that help me enjoy, the Hellcat or the 911. And I wonder, do you think we're going to be able to enjoy electric vehicles as much in the future, Holger? Are you working on technologies that's going to make EV fun for consumers?
Hey, I would expect that you drive as well in your garage where you have those multiple cars. I envision it, Matt. You will have an e-vehicle as well. And how could you not in New York? And it might be an e-Hummer even, right? So it's fun cars. It's really fun cars. You can sleep well with your ecological consciousness and as well have fun. E-vehicles are perfect for having fun as well.
All right, Holger, great to catch up with you. Thanks so much for joining us. Holger Klein there, CEO of ZF Group, talking to us from the IAA in Hanover. I have driven the electric Hummer, the GMC Hummer, which is like a 9,000-pound fortress on wheels, but it's got a more than 200 kilowatt-hour battery, so it moves with the power of a muscle car.
How does it compare to a Cybertruck, though?
I haven't driven the Cybertruck. You're just trying to twist the knife,
I totally
aren't you?
am.
Yeah, I haven't driven one. Hannah Elliott, my partner in crime, I have a podcast about cars called Hot Pursuit. Hannah's driven the Cybertruck, and she actually was really impressed by it.
How do you feel about the aesthetics, either direction?
I prefer the Hummer myself in terms of the way it looks.
I prefer a two-door sports car. I don't want anything large.
No, you're a BMW girl through and through. I could see that, or a Porsche. You might like.
I would love a Porsche.
Other German cars.
If somebody would like to, take me for a ride in one of those, I would be very
You know what? You're on. I'm going to get a pink Porsche next week to test drive. No, this one's pink. It's called, I think, Ruby Star Neo is the official name of it. It's more of a mauve, but I'll take you out in it.
Don't miss Matt's podcast.
Make some video. Definitely check out my podcast, Hot Pursuit, with Hannah Elliott. It's out every week. You can get that on Bloomberg.com, on Spotify, or wherever else you get your podcasts. Let's take a check on the markets quickly with Abigail Doodle. Abby, what do you see?
Well, we have an interesting day here. We, for the most part, are looking at the major averages down. The S&P 500 had been flipping between red and green. It's now down, and you can see why here. The NASDAQ 100 down about 1%. Tech weakness. That S&P 500 tech index down 1.3%. On the other hand, we have the banks rebounding a little bit from last week. And take a look at energy, up 0.8%. So some of that rotation out of tech happening. And it, of course, has to do with NVIDIA and Apple. Apple at the lows, down nearly 4%, the worst day in more than a month. If we take a look at the Apple chart, it's interesting what's happening here for sure in the Bloomberg terminal. You can see earlier this year out of the dip, dipping down more than 10%, the peak at that point down in December, and then higher. Right now, this is a big area of congestion. What I really want to point out here is this gap lower for Apple. That tells you that investors very surprised by this bearish research report coming out of TF International Securities talking about the idea that the iPhone 16 Pro, the uptake not as fast as last year. In fact, on the first weekend, down 13%. It does point to the idea that we could go back to the August low. That's right above the 200-day moving average. Overall, even, there's reason to believe an equal and opposite move of this area of congestion could take us right back down toward these these lows. There's a lot of work to happen. But today's gap, that's something really to pay attention to. Again, it tells you how surprised investors are. And then take a look at coffee. I don't know about you, Sonali and Matt, how you feel about coffee. I certainly love mine. Well, we do have coffee on the year surging, the highest level since 2011. That, of course, is one more problem that Starbucks is facing, those higher costs. CEO Brian Niccol probably on it.
I do love my coffee, Abigail. You are playing right to my heart here. But of course, not at those prices. Oh, well, you don't need any more caffeine.
No, I've got that straight edge.
She's got that straight edge. Anyways, we are going to stick with cars. We're going to talk about the new chapter for Wall Street Week, and it's on the road. We're going to go to Detroit to hear from Congresswoman Haley Stevens on the role that lawmakers are playing in the transition to electric vehicles. Stick with us for that conversation next. This is Bloomberg.
Time now for our daily Wall Street Week conversation. Automakers are pulling back from their once grand EV ambitions, conceding that the transition is going to be harder than they initially expected. Congresswoman Haley Stevens represents the Detroit area. She told Wall Street Week's David Weston how she sees the progress U.S. automakers are making on EVs.
Well, I'm so proud of our domestic automakers for continuing to innovate, continuing to lead the way. They've doubled down on particularly electric vehicles in the plight towards zero emissions. They've made the strategic investments. And the automakers that we have today, as we head into the year 2025, are so different than the automakers of the turn of the century. And that's a note of pride. Not only are sales somewhere between 15 and 16 million, we've got 1.2 million electric vehicles being sold here in the United States. We've got more than just a burgeoning marketplace in this respect. But it's not single shot. And none of us fully know how the consumers are going to embrace electric vehicles. I know anytime I get with an automaker, I'm asking, how are these cars being sold? What needs to be done? In addition to looking at the infrastructure investments, the factory investments, the fuel cells, the things that are taking place that are of course, ushering in this revolution. But one thing is very clear, is that the world is moving towards electric vehicles. We're seeing this in markets on all continents. And we want the United States automakers and workers to be leading the way. We want them to be dealt in. And it's their cues that I'm taking as a policymaker to put into place the infrastructure, the production capabilities, as well as the entire foundation that will see these transformations take place. In terms of where the consumers are going to go, you're certainly seeing a lot of two-car families, one car's zero emissions electric vehicles, an electric vehicle, and their other car is still an internal combustion engine. I regularly, David, meet with suppliers. I have a program called Manufacturing Monday. I've done well over 200 unique visits, primarily to small businesses, small manufacturers, over the last 6 years. And what I have seen very up close, beginning before we passed things like the infrastructure bill or the Inflation Reduction Act, which made a lot of these clean energy investments, is that our supply base has had a dotted line to electric vehicles. They've known where the industry is moving. They're listening to the automotive CEOs. Certainly our executives, they see themselves in this very grand and aggressive competition with the Chinese Communist Party, to say the least. We want to continue to win the day. And that's why it was so important when we passed the new NAFTA agreement, USMCA, to bolster Buy American content, to compete globally on the world stage as not just an auto industry, but as a manufacturing base.
As we move toward this electric vehicle future, can we bring the auto workers along with us? You mentioned auto workers. There's a lot of concern. The UAW in the last contract negotiation, it was a big issue. What is the role? What does it do to the role of the auto worker in the new world?
Well, we're certainly very proud of the United Auto Workers Union and the way in which they have negotiated for fair contracts, particularly 15 years after they were such a critical part of the deal to save the domestic auto industry, making enormous sacrifices themselves, as well as continuing to work to secure the retirement benefits of their workers. And I'll just say this, that it is a healthy skepticism. We're certainly seeing some volatility in the market. I'm eyeing Chrysler very closely, now known as Stellantis. I'm eyeing Stellantis very closely, in part because as they're transitioning, they're winding down some manufacturing. Then they're announcing job layoffs. They've got tight contracts, but there's also some tough conversations that are taking place, even though those contracts have been set. In part, we don't want to be ushering in anything that isn't fair for the hardworking men and women of our auto industry. I see a future for us. We could be very comfortable continuing to just exclusively make internal combustion engines, and yet we'd probably be losing out then, particularly with where foreign markets are going. So I'm looking at today as well as tomorrow and what is going to secure jobs and good paying jobs. And I'm very proud of how the UAW negotiated for fair contracts, negotiated for safety, ended some of the legacy considerations that were disadvantaging some of their workers, particularly in terms of pay. And now we got to move forward, and we got to have everybody at the table together. We've got to be practical, and that's the unique role that lawmakers such as myself, particularly from the great and beautiful state of Michigan, we will continue to play moving forward.
That was Michigan Congresswoman Haley Stevens. David Weston joins us now to tell us about the next chapter of Wall Street Week. So I guess before we get into all of that, and I want to unpack that.
Sure you do.
I want to hear about the new show, right? It's debuting. You're launching the new program this Friday.
Yeah, as you know, Wall Street Week has been through all sorts of iterations going back to Louis Rukeyser, right? And this is now a next generation, which basically is a news magazine for business and economics, is what it is. It's sort of like a 60 Minutes, as it were, where we tell stories through people like Haley Stevens, and Jim Farley's in that piece as well as the mayor of Detroit, Mike Duggan. They're all in it, but it's really telling a story, and that story is a story about Detroit, its rise, its fall, its attempt to rise again, and the auto industry, and a story you know terribly well, what electric vehicles mean for all that.
Anyone who's got to share the office with you knows that you have been on the road, and you are all over the country really speaking to business leaders as well as people affected by those decisions. Where have your travels been taking you?
Well, we've gone to Dallas, actually Allen, Texas, north of Dallas, to visit those data centers. We hear so much about investing in data centers. We actually went to one and walked around it and looked in it and talked to them about exactly what goes into a data center. We also went out to Kalamazoo, Michigan, back in Michigan, not far from Ohio. Went to Kalamazoo, Michigan, where Zoetis, which is the world's leading provider of healthcare for pets, like really high-tech healthcare. That's where their research center is, and we interviewed the CEO, Kristen Peck, out there about an amazing business, actually, tens and tens of billions of dollars every year, and it grows 8% a year. Pretty good business.
My best friend went to Kalamazoo. I spent a fateful college weekend there.
My best friend's from Grand Rapids, so
we
love
people from Michigan.
We flew into Grand Rapids and drove down.
So back to Haley Stevens, and I think progressive Democrats especially have a really difficult line to walk in terms of trying to, promote EVs because they're cleaner in terms of tailpipe emissions, and they want to stave off global warming, and also trying to back unions because these workers' jobs are clearly threatened. Building an EV takes far fewer workers than building an internal combustion engine.
I think you've got it exactly right. And you sort of heard Congresswoman Stevens trying to walk that line, that she really believes in EVs. At the same time, you just can't deny what you just said. There are going to be fewer workers. Now, what they typically say is, yeah, but there'll be other jobs and ancillary businesses for it. We'll see if that's true or not. But most economists think, no, there'll be fewer jobs as a practical matter. There's going to have to be a transition.
David, we look so very much forward to the show relaunched. Our thanks to Wall Street Week host David Weston. More on the new Wall Street Week this Friday at 6 p.m. New York time. This is Bloomberg. And it's time now for the Trading Diary, what you need to be watching this week. The big week for central banks. Investors are preparing for the Fed to cut rates on Wednesday. But remember, there's also the Bank of England and Bank of Japan deciding on policy this week as well. And there's key economic data, too, on deck. That includes retail sales, initial jobless claims, and existing home sales. There's still earnings as well. We get results from General Mills, which, of course, is fresh off of a new deal, Lennar, FedEx, and more. FedEx, of course, telling us a little bit more about what's happening with this economy, isn't it, Matt?
You didn't like that movie with Tom Hanks where he's stranded on an island?
I hated that movie.
That's a great movie. I love how they bring FedEx into that as well. Obviously this week, I mean, the BOE and the BOJ are expected to leave rates unchanged. So it's really all about the Fed. And you have to decide if you're in camp 25 or 50.
You need to decide if you think the carry trade still has legs, because if they go 50 and the Bank of Japan goes stable, they stay stable, then are we going to see some more hiccups in this market? There's an argument there that some of that is washed out.
Yeah, looking at the yen right now, trading at 140.47, but it went down to 139.58. So it's the strongest the yen has been in about a year. It's got to be unwound, I would say, the carry trade. At least the Japanese yen carry trade.
Basis points set off the market.
Yeah, I think that would definitely be a game changer for people involved in that. All right, tomorrow's program, we have a fantastic one for you. Even though Sonali is going to be in Washington, D.C., she's leaving me for a panel.
This chair of the CFTC.
We have Ed Hyman, we have Julia Coronado, we have Gabriela Santos and Brian Weinstein. It's a show you don't want to miss. This is Bloomberg.